Here is a statement that should disturb you. Every dollar in your wallet is someone else's debt. This is not metaphor. This is not exaggeration. This is the literal mechanism by which modern currency enters existence. When you understand this, you understand why the system behaves as it does, and why it cannot behave otherwise. Let us trace the origin of a single dollar. Currency does not materialize from vaults of stored wealth. It is not mined from the earth or harvested from productive labor. In the modern system, money is created through the act of lending. When a bank issues a loan, it does not reach into a vault and withdraw existing funds. It creates new currency units through an accounting entry. The borrower receives digits in an account. Those digits did not exist moments before. This process has a name: fractional reserve banking. A bank is required to hold only a fraction of its deposits in reserve. The remainder can be lent out. But here is where the multiplication occurs. When Bank A lends money to a borrower, that borrower typically deposits or spends those funds, which end up in Bank B. Bank B then holds a fraction in reserve and lends the remainder. The cycle repeats. A single original deposit can generate 10, 20, even 30 times its value in total loans throughout the system. The implications are staggering. The vast majority of currency in circulation was not created by governments printing physical bills. It was created by private banking institutions issuing loans. Every mortgage, every car loan, every credit card balance, every corporate bond represents new money entering the system. And every one of those instruments carries an obligation. The principal must be repaid, plus interest. Here lies the structural impossibility at the heart of this design. If all money is created through debt, and all debt must be repaid with interest, then the total debt in the system must always exceed the total money supply. There is never enough currency in existence to repay all obligations. This is not a temporary imbalance. This is an inherent mathematical feature. The system requires perpetual expansion to survive. New loans must constantly be issued to create the currency needed to service existing debts. If lending stops, if credit contracts, the currency required to meet obligations simply does not exist. Defaults cascade. The tower begins to collapse. This explains behaviors that otherwise seem irrational. Why do central authorities panic when lending slows? Why do they reduce interest rates to near zero, even negative territory, to encourage borrowing? Why do they directly inject currency into financial markets during crises? Because the alternative is systemic collapse. The machine must be fed. Consider the scale of this construction. Global debt now exceeds $300 trillion. This figure surpasses the total annual economic output of the entire planet by a factor of 3. Every nation, every corporation, every household is woven into this web of obligations. The tower grows higher with each passing year, its foundation of new debt expanding to support the weight above. The ancient story of Babel described a tower built to reach heaven. That tower fell because its builders could not communicate. The modern tower of debt faces a different limit. It falls when the new debt required to sustain it can no longer be issued, when borrowers are exhausted, when collateral is depleted, when confidence evaporates. Those who designed this system understood its requirements. Perpetual growth is not an aspiration within this framework. It is a necessity. An economy that stops growing under this model does not stabilize. It collapses. This is why every policy, every intervention, every emergency measure aims at one objective: keep the expansion going. But infinite expansion in a finite world is a mathematical impossibility. The tower rises higher each year, and the builders assure us the foundation is sound.
But debt is a claim on future productivity. When that claim exceeds what the future can deliver, the reckoning arrives. The question is not whether this model has limits. The question is when those limits become binding and who will bear the cost when they do. In the next chapter, we will examine who profits during the expansions and who suffers during the contractions. The pattern is remarkably consistent and remarkably convenient for those who understand it in advance.
There is an old term in finance that deserves resurrection, the shearing of the sheep. The metaphor is agrarian but precise. Sheep are allowed to grow their wool over time. They graze, they fatten, they accumulate. Then, at the appointed season, the shepherd arrives with shears. The wool is removed. The sheep, lighter and colder, begin the cycle again. They have no understanding of the pattern. They only experience each phase as it arrives. This metaphor describes a recurring phenomenon in economic history. The cycle operates with mechanical regularity. First, credit expands. Money becomes easy to borrow. Asset prices rise. Ordinary people, observing their neighbors grow wealthy, enter the market. They purchase homes at peak prices. They invest savings in stocks at historic highs. They believe they are participating in prosperity. Then the contraction arrives. Credit tightens. Lending standards increase. The currency supply that was expanding now reverses. Asset prices fall. Those who purchased at the peak find themselves holding assets worth less than their debts. They sell in panic, accelerating the decline. Foreclosures multiply, bankruptcies cascade. Wealth accumulated over years evaporates in months. The pattern has repeated across centuries. The panic of 1907, the crash of 1929, the savings and loan crisis of the 1980s, the dot-com collapse of 2000, the financial crisis of 2008. Each episode follows the same script. Each is later described as an unpredictable shock, a black swan, an accident of markets. But accidents do not recur with such regularity. The expansions and contractions are features of the system, not aberrations. Credit expansion creates the conditions for the bubble. Credit contraction triggers the collapse. Those who control the timing of these phases possess an extraordinary advantage. Examine who emerges stronger after each crisis. In 2008, millions of families lost their homes, retirement accounts were devastated, small businesses collapsed. Yet within the same crisis, the largest financial institutions received emergency support measured in trillions. They survived. Many grew larger. The decade following 2008 saw unprecedented consolidation of financial power. The sheep were sheared. The shepherds prospered. This is not conspiracy. This is documented history. The mechanisms operate in plain sight. When credit expands, wealth disperses. When credit contracts, wealth concentrates. Those with access to liquidity during contractions can purchase distressed assets at fractions of their previous value. When expansion resumes, those assets appreciate. The cycle completes. The 2020 crisis accelerated this pattern beyond historical precedent. Small businesses closed by the millions, employment collapsed, yet asset markets, flooded with emergency liquidity, reached all-time highs within months. Those who owned assets before the crisis saw their net worth expand dramatically. Those who relied on wages experienced stagnation or decline. The wealth gap widened faster than at any point in modern measurement. There is a term for this phenomenon, the K-shaped recovery. The letter K illustrates diverging paths. One arm rises, those with assets. One arm falls, those without. The same crisis, the same policies, producing opposite outcomes depending on where you stand in the structure.
Understanding this pattern changes how you interpret events. When authorities announce emergency measures to save the economy, ask a precise question: whose economy? The interventions are not neutral. They enter the system at specific points. They benefit specific participants. The language of universal rescue obscures the reality of targeted advantage. The sheep do not design the shearing schedule. They do not decide when wool prices rise or fall. They do not choose the season of harvest. They only experience the cycle, believing each phase to be the natural order of things. You now know the pattern. The expansion feels like prosperity. The contraction feels like catastrophe. Both are phases in a recurring process that transfers wealth from the many to the few. Knowledge of this pattern does not guarantee protection, but ignorance of it guarantees vulnerability. In the next chapter, we will examine the architecture that makes this possible on a global scale, how one currency became the foundation of international trade, and why nations thousands of miles away must absorb the consequences of monetary decisions made in a single capital.
There is a privilege so extraordinary that those who possess it rarely acknowledge its existence. Imagine you could print currency in your basement, and the entire world was obligated to accept it for trade. Your debts would always be payable in paper you create. Your imports would cost nothing but ink. Your deficits would be absorbed by others. This is not fantasy. This is the current structure of international finance. How did this arrangement come to exist? The origin traces to 1944, when delegates from 44 nations gathered at a resort in New Hampshire. The war was ending. A new economic order was needed. The agreement reached at that conference established a single currency as the foundation of international trade. All other currencies would be pegged to it. It would be convertible to gold at a fixed rate. The nation issuing that currency would become the banker to the world. For 27 years, this system operated as designed. Then came the Sunday evening announcement in 1971. The gold convertibility was severed. But here is what did not change: the currency's role as the global reserve. Other nations continued to hold it. International commodities continued to be priced in it. The privilege remained, even after the promise backing it was withdrawn. This creates an asymmetry without historical parallel. When this system creates new currency units, it does not merely dilute its domestic purchasing power. It exports that dilution to every nation holding its currency in reserve. Central banks around the world maintain vast stockpiles of this currency to facilitate trade and stabilize their own monetary systems. When those holdings lose value, the loss is theirs. The mechanism operates through international trade. When this system runs a trade deficit, it sends currency abroad in exchange for real goods: automobiles, electronics, machinery, labor. Those trading partners accumulate currency reserves. They must do something with these reserves. Typically, they purchase debt instruments issued by the same system that created the currency. The currency returns home, but the goods do not. This is a closed loop of extraordinary benefit. Real goods flow in, paper promises flow out. The paper promises are then lent back, financing further consumption. The arrangement has continued for decades because the alternative, refusing the currency, would devastate the export economies that have become dependent on access to this market. There is a term for this arrangement: the Triffin dilemma. A global reserve currency must be supplied in sufficient quantity to facilitate international trade, but supplying it requires running persistent deficits. Those deficits accumulate. The debt grows. The sustainability of the arrangement depends on confidence that can evaporate. Consider the geopolitical dimension. A critical commodity,
The energy source that powers industrial civilization has been priced in this currency since the 1970s. Any nation wishing to purchase this commodity must first acquire the currency to do so. This creates permanent global demand. It ensures that no matter how much new currency is created, buyers will always exist. Those who have attempted to price commodities in alternative currencies have faced severe consequences. This is not economic theory. This is historical record. The architecture of global finance is maintained not merely by market forces, but by the strategic interests of those who benefit from its continuation. The result is a system where one economy can consume beyond its production indefinitely. Its deficits are absorbed by the world. Its inflation is distributed globally. Its monetary decisions ripple through every economy on the planet. When it expands credit, bubbles form worldwide. When it contracts, crises cascade across continents. This is not a critique of any nation's character or intent. Any entity granted such privilege would likely exercise it. The observation is structural, not moral. The system creates incentives. Actors respond to those incentives. The outcomes follow with mechanical predictability. But systems built on asymmetric privilege generate resentment. Efforts to construct alternative arrangements, different reserve currencies, different payment systems, different commodity pricing mechanisms have accelerated in recent years. The architecture that has governed international finance for 8 decades is facing its first serious challenges. Whether it adapts, transforms, or collapses will shape the coming era. You now understand the global dimension. The monetary system is not contained within borders. The decisions made in one capital determine the financial reality experienced by billions who have no voice in those decisions. The privilege has been immense. The question is how long it can persist and what emerges when it ends. In the next chapter, we turn from analysis to application. If this is the structure of the game, what constitutes a rational strategy for those playing it? How does one distinguish between currency and wealth? And what does genuine financial security look like in a system designed to erode it?